Thank you for joining today's webinar on coping with the uncertainty of COVID-19, critical decision-making on plan funding and the potential impact on plan demographics. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our Expanded Center for Online Learning. As we all adjust to the new COVID reality, please bear with us if there should be any technical issues or unplanned background noise during our webinar. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics, we will hold your questions till the last part of the program. Today's webinar is sponsored by Gabriel Roeder Smith Co. Let me start with a few words about our sponsor and then introduce the presenters. Gabriel Roeder Smith, GRS, is an actuarial and benefits consulting firm with a nationally recognized reputation that specializes in public employee retirement issues and has clear understanding of the national, state, and local political environments in which public sector plans operate today. Today's presenters are Joe Newton and Ryan Falls. Excuse me. Joe is the pension market leader for GRS. In this capacity, Joe's functions in one of the most senior political roles in GRS, providing significant firm-wide leadership and contributions at the highest levels. He is a nationally recognized public sector actuary who works with numerous statewide, regional, and local retirement systems and is located in GRS's Dallas, Texas office. He has more than 20 years of actuarial benefit consulting experience. Ryan Falls is a senior consultant also at the GRS Dallas office. He has over 20 years of actuarial and benefit consulting experience, focused on the needs of major public employee retirement systems and private sector employers. Throughout his career, Ryan has provided consulting services to statewide and municipal retirement systems across the country. Joe, Ryan, the webinar is yours.
Thank you, Hank. Appreciate that introduction. Hope that we find everybody healthy and safe out there. And we're happy to be here today. Looking forward to this conversation about decision-making in today's environment, especially with regards to the funding of our plans and some of the decision-making around that as we move forward. I apologize if we were muted there. I'm not exactly sure how far back the muting went, but I'm just going to start over and just say thanks for the introduction, Hank. Hope we find everybody healthy and safe out there listening in. We're happy to be here today. We're really looking forward to this conversation about decision-making in today's environment, and especially with regards to our plans and how they're funded. So we all every night after working diligently at home in our home office, sit down in front of the news, read the newspaper. If anybody does that anymore, reads their articles, and we're all monitoring the statistics around this virus, and every day there's new statistics. We're monitoring the investment markets and what they're doing, whether or not we were really up or really down for the day. Also monitoring our local economies and our stay-at-home orders and what our governors are doing with our local economies and businesses and shelter-at-home rules. So as we're processing all of these headlines, we're going through every day with new headlines and new data points. Our thoughts naturally progress, especially those of us in this industry. How is this going to impact our plans? What should I be doing? What should I be focused on with regards to my plan to support my retirees and our constituents? And that's really where we wanted to come today with our presentation, is to talk about really what we think where our focus should be placed and where we should be focused and how we should be making our decisions. So agenda today, just talk a little bit about where we stand today and set up the conversation we're going to have. The question we get most often, I think, is what's on top of everybody's mind, is how is this virus going to impact our plan with respect to the rates of mortality and how that's going to impact our plan for the long term. And then the bulk of our comments are really going to focus on the volatility we're seeing in the markets and kind of how we should approach our planned funding in the midst of all of this volatility, with really the ultimate goal of the sustainability of our plan going forward. So where we stand today and what we do know, or really it's more what we don't know. As I was putting this presentation together, I think I put more question marks in this presentation, as you see through the slides, than I've ever put in a presentation. And really what that drove home to me as I was putting this together is there's just so much we don't know. You know, where are we with our economy? The markets are a roller coaster. From about Valentine's Day through March 23rd, the US equity indexes all lost 30 to 35% of their value. In just the last week of March, about a third of that ground was gained back. And over the course of April, we got about another third of that back. So we're about 2/3 back from where we started. Even just the last week, it's been up and down, but you know, we're about the same place. So what will the next month, quarter, year hold? And maybe more importantly, where's your valuation date gonna fall in some of these cycles? But we just don't know. We move on and just think about our country and our economy in general. Joe and I, as Hank mentioned, are calling in from Texas today, where we've started to relax some of our shelter at home rules. Probably be a couple weeks before we know how that plays out, but we're obviously all very interested to see how that turns out. And just across the country and across the world, how are consumers going to roll out, and when are they going to start spending their money in the economy again? Will there be another wave of shelter-in-place orders? And a lot of those questions are important to us as working as public employees, because that's really going to drive the tax revenues that you know are funding our municipalities and our states, and how our plans are going to be funded, and the employment levels at these employers. So it obviously has a big impact on us. And as we've all learned, or at least trying to learn, how to work from home, and how is that going to impact work-life balance and our employers' approach to employment going forward? Lots of questions, things we're still yet to learn. And what I'm trying to reinforce here is that we just don't know where we sit today, and we're not going to know for a long time on really where we will be, what our future state's going to look like, in particular for our pension plans. But there are things we can do today to better position ourselves going forward. That's really our message today. And on slide 6, we think about our pension plans. Obviously, the most important function, and all of our clients, talking to all of them, they're doing a great job of this, is focusing on the administrative functions, making sure that the checks are getting paid, the contributions are getting processed, people with questions are getting their question answered. Those functions are vital functions that are getting done. And also monitoring asset allocation liquidity needs in this volatile market. Investment staffs, investment consultants are all focusing on a daily basis. Vital functions that need to be focused on. As we start to think a little bit forward, obviously how those investment earnings and the contribution dollars we're actually receiving are important, and obviously are concerned, and that how those accumulate over the medium to short term are really going to set the stage for our trajectory going forward. We're obviously getting a lot of questions from our clients about what's this mean for our funded status or unfunded liability, what's our actuarial metrics as a result of that. But really these actuarial metrics don't change that fast, whether it's because we only measure once a year for the most part on an actuarial valuation date. And even on those actuarial valuation dates, we've got asset smoothing and different contribution smoothing techniques. So how quickly our actuarial metrics are going to change really shouldn't be a focus right now. Obviously, it's what everybody knows and understands, but it shouldn't be our focus. And I think we'll talk about that a little bit more as we go forward. So first, to talk about mortality and the demographics and how we expect that's going to impact our plans for the longer term. Again, more question marks. Sorry about that. But as we process all the stats we're seeing about the impact of the virus, there's a lot of delay. There's new stats. There's different stats. It's really hard to kind of get your hands around what the true impact of this is going to be. But really what's going to impact our plans are the longer term trends and how those emerge around life expectancy and especially those of those covered in our plans. So we're going to look at maybe what some different extremes might be and how those different extremes might play out. I mean, obviously the cohort that we're most focused on with our pension plans and our retirees is the cohort over age 65. That's really where the bulk of our retirees are, where the bulk of the liability of our plans reside with these annuitants. Early on in the pandemic, it seemed like that maybe overall deaths were lower. And you can see the blue line here kind of trends beneath the historical norms of overall deaths in this cohort was being attributed to maybe everyone staying at home and kind of staying out of situations that might cause this. But clearly over the following few weeks, the impact of the virus really started to show through and to really take its full effect. So we can see that a real spike in the overall number of deaths through the middle of April. So clearly the virus is having an impact on overall. This is all deaths from all causes, but clearly a spike in deaths, and which will have an impact on our pension plans. And the question is, how big is that impact going to be? So on one end of the spectrum is that this is kind of a one-time shock event, that we're going to have a spike in mortality for a period of time, 1 year, 6 months, whatever it is. But we'd expect long-term that historical trends to really settle back into past expectations for life expectancy. And as we all know, the group that's being most impacted by this virus are those with advanced age, and a lot of them with a higher percentage with pre-existing conditions before contracting the virus. And really when it comes to our pension plans, this group really doesn't have a significant liability in our plan when we think about where the present value of the benefits is and that we're trying to fund. So if we find ourselves in a situation where it's a one-time shock event, but over time we expect to go back to normal kind of trends and patterns, this isn't going to have a significant impact on our pension plan and the funding of our plans. Now, the flip side of that would be for a life insurance company or a book of life insurance policies, really kind of a polar opposite of a pension plan. Well, if we have a one-time event for a pension plan where mortality spikes, really, as you can see here in this picture, just graphically, the present value of the benefits really doesn't change for the long term for a book of annuities or a pension plan. But for a life insurance a book of life insurance policy or life insurance companies, that outflows in 1 year could double if we had a one-time spike in mortality. But for the payouts from pension plan really aren't going to be significantly impacted. But obviously there's another side of the spectrum that what if this current pandemic signals some sort of broader overall change in future mortality trends, whether it's this COVID-19 virus or another virus or some other sign, some other just cascading pandemics that go across the globe with some regularity going forward, that would obviously signal a larger shift in life expectancy and mortality rates. And as you would expect, that would have a much more significant impact on our pension plan. Obviously, from a life expectancy standpoint, shorter life expectancy would mean potentially fewer checks that our plan has to write every month, but it could also cause an overall shift in work-life balance and retirement patterns, incidence of disability, lots of different cascading effects on our plans. So that's obviously a much more significant, but that's really to kind of draw the polar opposite, to draw the extremes and to build those pictures in our mind on what the impact on our plans could be. From this point forward, we're really going to try to focus on the market volatility and how that will impact our plans going forward. Obviously the length of this downturn will have a big impact and the magnitude of the downturn and when we start to kind of see the markets come back. But there's also a lot of plan specific factors that Joe's going to talk a lot about that are going to play a role in this. What's your starting point? What's your funded status? And what are your liquidity requirements before leading into this downturn? where's your position with regards to net cash flow or net payouts, your contributions relative to your benefit payments, and how are our contribution policies going to, will there be a change in our contribution policy because of this downturn, and how that could impact the funding of our plans over the long term. And really, with all of this uncertainty and the question marks, really the buildup, what I was getting at is we really don't know where we are with all these different trends and all these different statistics. But our message today is really to trust the process. That since the Great Recession in 2008, 2009, well, that was a really challenging time for all of our plans. Volatile markets, reduced workforce, really all of the things that we're seeing come to fruition today with our plans. It was a really challenging time. But since 2009, nearly every governmental plan has enacted some sort of meaningful reform. A lot of that was around benefits, a lot of benefit reform, but also a really important initiative around funding and the focus on funding policies since Great Recession. How should our plans be funded? Before the Great Recession, a 30-year rolling open amortization period was probably considered the gold standard. A lot of plans monitored their funding that way. Of course, before 2008, 2009, our unfunded liabilities were significantly smaller than they are today, so that maybe didn't have as big of an impact. But hopefully, really best practices have evolved since the Great Recession, and with this increased focus on funding policies. Been a lot of great white papers over the last 5 or 10 years about how our plans should be funded. A lot of new terms that hopefully we're all very familiar with, things like negative amortization, closed amortization periods, layered amortization, a lot of different strategies towards funding our plans with an ultimate goal of really eliminating this unfunded liability. And with that, improving the sustainability of our plans for the long term. And I think that really can be seen in December of last year, Nazarene in their issue brief pointed out that approximately 75% of plans in the public fund survey are now consistently receiving at least 90% of their actually determined contribution. That's a great improvement. We'd like to see these percentages improved even more, but it's a really good place to start from as we focus on the funding of our plans going forward. And really, this last point here, really the most important message that we want to convey today, that wherever this pandemic leads us, and as we've already set up, we don't know where it's leading us yet, but now's the time to trust the funding policies and the processes we all worked so hard to put into place over the last 12 years. Been a lot of thoughtful and deliberate changes to our plans and our funding policies. Even on the benefit side, a lot of contingent benefit provisions were put into place, things that are put into place for times like today, when we find ourselves in a difficult situation with the markets and with our economy. These funding mechanisms, these benefit mechanisms help keep our plans on the right path so that going forward, we're in a better position. So with that set up, I'll turn it over to Joe through his analysis.
Great, thanks, Ryan. Yeah, we're going to really switch gears here, start getting into a little bit more math. Of course, this is an actuarial presentation. These have some math somewhere. And we're going to kind of talk about net cash flow and the impact of some of the ideas that we're hearing of, headcount reductions, reamortization strategies, maybe just contribution holidays in some regard, and the possible impacts those could have, and maybe a couple of different ways that are not quite just a straightforward way of looking at it. So the first thing we want to introduce here, just big picture, is this is a graph of the S&P 500 on a weekly basis over the last 20 years. And this is not investment advice. We're not investment managers or anything. But in general, if you're just trying to maximize the amount of assets you have at the end, and it's important to remember, pension plans pay benefits with actual dollars of assets. They don't pay them with rates of return or contribution rates. It's actual dollars at the end of the day. And so you can see here, I mean, just in general, you'd want to be buying more or maybe putting in more when the market's lower and maybe, contributing less or selling, at the top. If you're just trying to maximize how many dollars you have at the end of the process. So we'll kind of talk about this being maybe the optimal way. Of course, this is much easier said than done in retrospect, but in general, this is the way you'd want to see it. Now, we're going to talk a little bit about net cash flow or net payout, and they're really the same thing, just looked at it from opposite directions. Net cash flow is usually a negative number, and so the benefit payments would be negative, and then you subtract out the contributions, and so there's some balance there, and that's the trust fund is responsible for that balance. Net payout is the same thing, just talked about in a positive amount, so the benefit payments would be positive. And it's important to remember pension plans should have, negative net cash flow. They should be paying out more than they're receiving. That's the whole point of the trust fund, is to help pay the benefits over time. However, this is one of the things you have to manage, and the net cash flow needs to be in a reasonable and predictable amount, because that really has to do with liquidity requirements and what kind of asset allocations are appropriate. So we're going to kind of look at the impact of net cash flow here. I've got 3 examples just for comparisons. Benefit payments, you can see in all 3 cases are $1,000. In example 1, they're receiving $700, and so their net payout would be positive $300. So example 2 has the same benefit payments, but they only collect $500, and so their net payout is the balance, $500. And then you see the market value of assets for all 3 examples, and then the net payout as a percentage. So you just take the 300 over the 10,000, you get 3%. So you can see example 1, 2, and 3, net payout of 300, 500, 500, but because the assets are different, the net percentage as a percentage of assets are different. So this is showing you that we can't just look at one metric. We kind of have to look at a combination of things to see the true circumstance, and you can have the same dollar amount of net payout, but be in different liquidity requirements. But this is just to help you help define net payout. So the impact of this net payout on asset accumulation over time, we're just going to show a little math example here. A liability with a 0% discount rate, okay, so it's not expected to change. So the liability of $100 just stays at $100. The assets, however, are going to have a 10% loss followed by a 10% gain. So the assets 100 goes down 10% to 90, goes up 10% to 99. And so we now have a $1 unfunded liability. The one thing that's interesting about this $1 unfunded liability is traditional ways of looking at asset actuarial losses and liability actuarial losses don't really have a way to account for this dollar. It's not really an asset gain or loss, and it's not necessarily clearly a liability gain or loss. So it's going to show up in the, often stated other segment of the gain loss reconciliation. And also, it doesn't always work this way. If the positive was first, if it was 100 up 10% and then down 10%, it actually would go the other way. But here now we're going to add some net payout. Example 2, same returns, but we're going to pay out $5 in the middle. So the liability is 100, take out 5, we end up at 95. The asset, however, loses 10%, pays out 5, so now you only have $85 to earn the 10% on. You end up at 93.5. So we now have an unfunded liability of $1.5, even though on a arithmetic basis, at least, we met our return assumption. In the cash flow, you can see basically what happens is every time net cash flow leaves, you're locking in whatever's happened up until that point, and the money's no longer available after that point to either ride up the good times, or like I said, if the positive was good first, it would do the opposite. But we're going to look at this impact of this net cash flow on accumulation of assets over time, and especially in downturns, since that's what we're really dealing with right now. And you say, well, that's a simple example. That doesn't happen in real life. Well, here is the S&P 500 in the last month and a half. It went down 34% from the top to the bottom, and then went up 31%. So we've had, on just a number basis, almost the same, but we're still 14% down from the top to the bottom. And if you had negative cash flow, which you probably do, you're a pension plan, this happened to you. You paid out net cash flow, and now that's not around anymore to earn the 31%. And so here we're going to look at a real life example of a pension plan. This is the asset level of the pension plan. We went back and used actual performance of a 75% stock, 25% bond portfolio, and interestingly enough, you get almost exactly a 7% compound return over that 20-year period. The kind of yellow beige color there is if you got 7% every year, so a nice steady line. But the blue line is what the actual market value of assets was on each valuation date. And so you can see you had the tech bubble, you came down into the 2002, 2003 low, came up into the Great Recession, and then of course the last decade has been very good. And we end up at 7% at the end. We also are going to have modeled for this client their payroll history because they get contributions as a rate of pay. So in these bad times, their payroll contracted. And so we've gone ahead and included that in the model. And then they also use a 30-year layered amortization. So this is kind of the starting point, but let's talk about what happens to this net payout as these downturns are occurring. So down here at the bottom, we put the net payout as a percentage of assets. So it's a positive number, but it's showing you what dollar amounts being paid out net. So you have your contributions minus your benefit payments minus your contributions. And so this is the balance between the two. The dark blue is what the baseline expects. So if we got this exact, really nice, steady return, you can see the net payout is pretty steady as well. But because of the volatility here, as this is pulling down, our net payout is going up, and it's going up especially as a percentage of assets because the assets is coming down. But in dollar amounts, it's also increasing because payroll in general is likely contracting. So here I show you the actual dollars during the Great Recession. Benefit payments was expected 37.84. Well, benefit payments aren't impacted by these events, so they're the same. The contributions expected 26.19. If we only were modeling actual investment performance, it would have also been 26.19. But you can see here with the payroll contraction that they actually got, we only received contributions of 2,389. So our net payout in dollars actually went up, spiked up by almost 300 million, or over 300 million in this case, right at the bottom. So right at the bottom of the Great Recession, we're paying out 300 million more than we anticipated. And so you can see what that looks like as ratios as well. It's almost twice as much as what the model was expecting. So when the asset allocation was set, say 2 or 3 years prior to this, they thought they were working with something like this, 2.8% payout, and the Great Recession, they actually had to deal with something like that. Now, if we turn this upside down now, so this is the negative cash flow, just so you can visually tell what's going on as a percentage of net assets. And so you can see during the the dot-com bubble, pay went up, so we actually had higher contributions. Then during the recession, we came down, which we have a spike out, so payout is increasing as the markets are going down. We come back up, going down. This is actually just like contributing more at the top, contributing less or selling at the bottom. Exact opposite of the example from earlier, where to maximize asset accumulation, you would be putting more money to work at the bottom and maybe less at the top. This is the exact opposite is what's going on. And this is happening to your pension plan. If you receive contributions as a rate of pay and your pay is contracting, this part is probably already happening to you in some fashion. The real discussion we're going to move to in a minute is what happens if employers are selecting to under contribute during this time, and it make this spike even worse. But again, what this is the net percentage of outflow as a percentage of assets comes down during the 2 recessions, and we're ending up contributing less during that time, or actually we have more money leaving the trust fund during that time. And so the questions we're getting on COVID is, and quite a lot of them is, well, what happens if we re-amortize? What happens if our head count goes down? What if we just take a contribution holiday? We have one that we know of where they're putting in 25% of the ARC right now. Well, and that happened during the 2008, and you can look back at 2008 and you can look back at 2003 at some of the plans that are doing the worst right now in this country. And these types of things were happening right during the financial crisis. And what ended up happening, their assets were so low by the time we got the recovery, it was just too late. didn't have time. So what we did is we took that same example and we are going to say, well, what if during a recession they only put in 70% of the ADEC? Okay, so they're going to put in their ADEC all other years, but during a recession they're going to choose to put in 70% of that ADEC. What does that do? So if you look at the net cash flow during the recession, now we're spiking down, and in fact during the Great Recession we spike from where we were about minus 3 or so all the way down to minus 7.4. So we pay out 4% of the trust assets more than we expected to right out. Now that is no longer around to ride up the recovery. And the ultimate cost, because I'm sure, if you're asked this question, what you'll say is, well, you'll put in $200 million less now. We'll put that over a 30-year amortization schedule with interest, and here's your cost. Well, that's not all the cost. The cost is not just the interest that you miss. It's also the opportunity cost on the returns that you miss, the earnings that you miss coming out of the bottom. And so there is an impact to the funded ratio here. The red line is if they don't take the contribution holiday, and the blue dotted line is if they do. And so visually they're behind. So we get up here at the top, we're about 3% behind on the funded ratio, which doesn't sound too bad. But here we'll get the actual numbers. The employer missed $1.5 billion in contributions. So if you add up all the contributions they missed here and here, 1.5 billion. As of 2018, so as of the end of the period, they've paid back 1.3 billion of it. Okay, so the amortization schedule that was put in place, they are paying back the 1.3 billion. However, at the end, they are still $2.4 billion less than if the contributions had not been decreased. And they're paying a 2% of payroll higher contribution rate for 30 years for those missed contributions. So clearly it's going to have an impact on the future outcomes. And the thing about it is you don't know who the decision makers are out here. You don't know what the situation is out here. And are people going to remember that this is why we're behind, that these contributions were missed back in time. So what's happened is the contributions, this is the dotted line here. The red line is if they didn't miss the contributions. The dotted line is if they do. So you can see during the recession, they put in less. During the recession, they put in less. Luckily, this plan at least has an actuarial determined funding policy so that a new 30-year base is set up to pay off those differences. And so they're putting in, you can see 2% more contribution, but at least this automatically occurs. And that's why the funded ratio, if we go back in a slide and look at that, that's why this funded ratio, even in the blue dotted line, improves and is catching back up, is because contributions were increased in the future. And so that's exactly what you see here. So we just want to talk real quick, the funding equation, back to this basics. And I'm sure your actuaries talked to you about this, contributions plus investment earnings is your benefits. Over time, this is all you have to deal with. If your contributions aren't there or your investments aren't there, one of them is going to have to make up the difference to try to pay out the benefits that you expect to pay. Well, as we just talked about, if contributions are being reduced and higher payout ratios because contributions are being reduce the total earnings that you are going to receive, what's happening to your benefit security? And so this is important to remember as these discussions are occurring, that lowering contributions from where they need to be needs to be seen as a direct potential impact to your benefits today. And so if you don't take that urgency, then by the time you realize the impact, it's going to be too late. And so what we try to do is talk about a few strategies to keeping those contributions high, even if your payroll is coming down. One we've talked about with some clients, even if you collect contributions as a rate of pay, is maybe during these times, or if headcounts are going down, is receiving full contributions on a budgeted amount instead of actual payroll. And there's a lot of plans out there that just receive dollar amounts from their employers, and so they're not really, that's not really an issue for them at this point. But if you do receive it as a contribution rate and your headcount is down or furloughs are being introduced or something like that, you need to be proactive about asking for the contributions to the pension plan to be on dollar amounts or budgeted payroll. And one idea that we've looked at with some clients, because they want to have the normal cost as a rate of pay, which makes a lot of sense, is switching so that your ADEC is actually stated in two different pieces. The normal cost is a rate of pay, the amortization portion is a dollar amount, and it kind of helps solve the same problem. But anyway, this is one way to look at it, is if discussions are occurring that would reduce payroll, that's your revenue stream, is to immediately ask for contribution to be based on budgeted or non-reduced payroll. One question we're getting asked a lot about is furloughs. What's the potential for furloughs to have to the pension plans? In general, almost universally, furloughs are going to be negative to the pension plan, usually because the members' benefits are not impacted very much. If it's a younger member, there'll be less contributions for them for some period of time, but by the time they get to retirement, their pay will be back to normal, so their benefits not going to be changed. But just in general, the ones that we've worked with in the past, the benefits were based on full pay anyway, even if contributions were being missed. So if that's true, then if furloughs are occurring, contributions need to be on full pay. Kind of back to the same idea from the previous slide, that if benefits are going to be based on full pay, contributions need to be on full pay. Now, that's probably going to be difficult for the member. It's going to be hard to get the member to pay that extra. Let's say you're taking 1 day a week furlough, so they're taking a 20% pay cut. It's going to be hard for them to pay that on their portion. But if you at least get the employer to pay its portion on that total pay, they can make a huge difference in keeping this net payout from spiking up. And then this last one is, what about just discretionary contribution reductions? So that would be like the one where they just say, hey, we're only going to give you 70% of our ARC this year. Resist. The cost is not 1 + I to the end. It's much more than that. And if you have to end up selling an illiquid asset, it will have a much bigger cost than that. We were dealing with some discussion with the client last week, and if they weren't having to move private assets, but if they were having to, they were looking at 60% on the dollar, 60 cents on the dollar for those. If you spike down and it causes you to have to sell one of those illiquid assets, that could really change the amount of assets you have over time. So resist. Is there another source of funding? In general, people ask about pension obligation bonds sometimes, and usually we're not, usually we try to find every reason to not use them. And I think if the question is, well, we're either going to go with normal life or get pension obligation bonds, that's one set of questions. But really what the question now is, if we're having to choose between getting half our ARC in a given year or the employer having to put out pension obligation bonds so that we get our full ARC, I mean, that seems like a no-brainer from the pension plan's perspective, that we need our money. So is there any source of funding during this downturn that we can get? And then this last one is, if the employer does short you, make sure that is itemized and an amortization schedule is set up as soon as possible. So from a funding perspective, put that over as short a period as possible. Just because you have a 30-year layered amortization does not mean a missed contribution should be a 30-year amortization. You could have a much shorter period, 5 years, 10 years, for something like that. But even if you don't get something like that, let's say you're using layered amortization and they missed $200 million of contribution, don't just roll the $200 million into your regular losses for fiscal 20. On the layered schedule, show that on its own. Miss 2020 contributions, $200 million. And that way you can always go back and point to the amount of money that you're short because of that action that occurred. It helps with transparency and also keeping track of what's happening. Even if you're a fixed rate plan, fixed rate plans don't have all the layers. They don't have as much, it's not as easy to keep track of things, but create a table in the report that shows that missed contribution shortfall and keep up with it from year to year, because someday down the road, there's going to be a stakeholder ask why you're in the situation you are. And it'd be really nice to point right back to that, that shortfall and say, well, this money grown with our actual performance would be this much. And so you can kind of pinpoint where some of that shortfall is coming from. We just want to talk just for a second about fixed rate plans, because all the things we've talked about so far are much more exaggerated in the fixed rate plan. And so there, about 25% of big plans in the country are on fixed rate, but I know, quite a few local plans are on fixed rate. And when we say fixed rate, what we're usually meaning is there's a contribution rate of payroll that's set by statute or some other source that's not actually determined and does not change. So if there's a trigger that forces it to change, that we wouldn't necessarily consider that fixed rate, or at least not purely. If you have benefits that change, so you have a fixed contribution rate, but your benefits float, I also wouldn't necessarily consider that fixed rate completely. But we're talking about a defined benefit plan, so the benefits are fixed, but you also have just a fixed contribution rate. It takes a lot of effort, and the reaction is always late. So we strongly recommend to our clients that are on fixed rates to begin talking about and moving towards more of an actually determined contribution rate. And this is exactly why. Here is that same client going through the same asset returns with the same pay, like everything is exactly the same, except that whatever their contribution rate was back here at the beginning was just set in statute, set all the way through. So from the beginning, the graphs were expected to look the same. But in here, we've only gotten the fixed rate throughout the period, plus the missing contributions in the blue dotted. So you can see down here, even though we earned 7% over the 20 years, even though payroll did grow about what was expected over the 20 years, it kind of did it in a volatile way, but it did grow. So most of your assumptions, if you looked at them over a 20-year period, came in pretty close. You can see we are well short of the 85% funded ratio that we were expected to be at. And in fact, if you've missed contributions, we're down here at 62%. So we have a 22% difference in funded ratio here. And it's because contributions haven't reacted when necessary. In fact, in here, the employer missed 1.6 billion in contributions. We're still behind by 4.6 billion by the time you accumulate all that with the missing asset performance through this period here. So clearly fixed rate plans have a much higher risk profile. And the biggest thing you can do right now is try to keep that contribution as high as possible in dollar amounts during this trying time. So Ryan's going to wrap it up here.
Yeah, sure. Thanks, Joe. Appreciate that. And just to kind of round it out and to summarize what we've been talking about, is obviously the most important focus right now is serving the retirees, serving the members, and managing the plan the best we can in spite of some of the difficult working arrangements and work from home situations. But then as we move forward and we think about the decision making around our pension plan, is to trust the process. Don't worry about the actuarial metrics along the way, especially amidst all the volatility. Don't worry about what our funded ratio is today, but to trust the funding policies, to trust the benefit policies that we put into place, that during saner times with after the Great Recession, but before the current pandemic, we made some very thoughtful decisions to put certain procedures and processes in place, and now's the time to trust them. And when it comes to conversations with the employers, and these conversations can be challenging because our plan sponsors and those contributing to the plan are struggling as well, but we have to advocate for keeping the revenue stream as normal as possible. And the cost of these missed contributions in these volatile markets is much more than just the time value of money. The negative cash flow, the volatility is really a drag. And then if we get, as Joe said, get into a situation where we're having to sell the liquid assets, it really starts to hurt even more. So that's really our themes for today. We'd love to answer some questions. If we don't have time for all the questions today, you're always welcome to reach out to Joe or I and to keep this conversation going. And in spite of the pictures shown here, we didn't plan to dress exactly the same on picture day, but it did turn out that way. Anyway, with that, I think we'll wrap up our prepared remarks, and we're prepared to answer any questions y'all might have.
Great, thank you, Joe. Thank you, Ryan. We do have a number of questions. First is, if an employee is furloughed and not being paid, does their lost salary really add to their pension benefit amount? Are we asking them to contribute on earnings that they will never accrue to their pension benefit?
Well, that's going to depend on the exact furlough provisions. But in the experiences I've had with furloughs, the pay was based on the full pay. The furloughs were taken out, so the pay were the pay was made whole. But even if it's not, to me, there's kind of two ends of the spectrum there. People that are currently eligible, let's say a dramatic furlough, once a week, 1 day a week, right? So you're working 4 days a week and getting paid 4 days a week, and it's going to be a while. Well, if you're eligible to retire, you probably go ahead and retire, right? I mean, why? You probably can get paid pretty similar, and your benefit's not going to really grow much more going forward. So that's one end of the spectrum. But for a young person, if you're 35 years old, let's say you're furloughed for 2 years, pretty dramatic. So you contribute less, your employer contribute less, you're still earning service credit, and then the furlough stops, so your pay goes back to normal and starts growing again. And someday when you retire, it's on that final pay. The fact that you were furloughed those 2 years has no impact at all on what your benefit ultimately is. But the compounding assets associated with those missed contributions will be material by the time the person is ready to retire. So I understand the argument that, well, they shouldn't have to contribute on it if they're not getting a benefit on it. But remember, in a final pay plan, it's not really how it works. In a cash balance plan, that's probably close to how it works. But the final pay plan, unless you're paid on your final pay, or close to it, not necessarily pay you're getting today.
And your comment kind of flows into the next question, which is relative to incentives for early retirement. Are you hearing or seeing any trends relative to plan sponsors encouraging its employees to retire early or take some sort of a separation package versus furloughs?
I have not personally been asked about early retirement packages, but that's some limitations there. I mean, there's only so many clients I work with. I am sure there are discussions, or I'm sure that if you're going to consider furloughs and that kind of thing, and you have individuals with lots of service who could take a pension benefit, I'm sure there's some sort of discussions going on there. And that gets back to that actually could make the net payout worse. That could actually increase the benefit payments we're making out at this time. And so we could actually spike our payouts, and especially if you have some sort of lump sum provisions, if you have a drop or partial lump sum options or even full lump sum options. And so we could actually make the situation much worse than even the baseline. So you need to make sure you're talking about all those things as employers are discussing those. But I think in this type of situations right now, I don't think the early retirements could just happen. They may not be packages and that kind of thing. They may just be more just not official, unofficial more retirements. So that's something to really pay attention to, because again, the cash flow at the end of the day, pension plans are cash flow models. That's what we're doing. We receive cash flow and we pay out cash flow, and the more retirements can impact the amount of money you pay out over the short term, for sure.
So relative to that, so in terms of sort of, we've been focusing on payouts, but in terms of cash flow in, certainly both of you have been stressing that, try to stay the course with your plan sponsors. In the event that that's not possible, just because of financial and economic realities, could you sort of triage the options that trustees and public plan stakeholders should be looking at from, best case, or not best case, but best alternative to the worst alternative? And obviously, I guess the worst alternative being, sort of pension holidays, as you guys alluded to.
But I think one aspect that Joe talked about is really trying to itemize that missed contribution and keep track of it, and just make sure there's transparency and communication about that. So when things get back to normal, you can have real conversations around that hole that's been formed by the furloughs or the temporary contribution reductions, and just to be real proactive about trying to recover that and recover it in as short a time as possible.
Right. You just have to remember that the the contribution stream and your benefit payments out are not independent of each other. The only source of money to pay those benefits is your revenue. Your revenue is your lifeblood. You know, if somebody was asking me, what's my, you know, is my body sustainable, right? Can I be alive a month from now? But I mean, I think there's a really high probability I'm going to be alive a month from now. You know, my age, and you know, I can eat and drink and that kind of thing. So, you know, but if someone said, well, you can't drink, you know, no water for the next month, now are you sustainable? Well, that's a very different situation, right? I mean, I need the water. Like that's part of me being sustainable. And so that's the same thing with the pension plan. Is the pension plan sustainable? Well, yes, with the revenue stream. And so and that's how urgent the, you know, especially trustees that are fiduciary need to take when someone starts really discussing about, is that revenue stream going to drop? That is the lifeblood. And so yeah, and I understand it's so easy to sit here and say, oh, don't let them do it. I mean, in real life, in general, you're going to be choosing between bad outcomes, right? I mean, that's the whole country right now is trying to choose between two bad outcomes, you know, health and economics. And there's not necessarily always a right answer. You try to balance it. And I would say in this case, if you're having to choose between jobs and salary and eating to pension funding, I mean, I understand where that probably goes, but just our point on that is just make sure, don't be naive in thinking that's going to not impact your pension plan. It will. And so be proactive about getting back to normal as fast as possible, or trying to find another source of funding as fast as possible.
All right, thank you for that, Joe and Ryan. And maybe it's something that you guys could think about for a little bit in terms of relative to what are the best sort of plan Bs if you can't get full funding. You know, is it extending the amortization period? Is it getting partial payment? Is it something else? But maybe for those who are trustees, administrators, and you know, stakeholders, so that as some of these discussions are going to happen in the next year or two or so, that they have at least sort of a sense of what might be the better plan B versus the worst plan B, if that makes sense. The other question is sort of related to this, is if a state or plan sponsor does take pension contribution holidays, you know, what do you think the long-term what do you think the long-term effect would be on our plans? Namely, you know, are our plans going to be around in the next 10 to 20 years?
Well, I don't think all plan sponsors will take the holiday. So, but I think for the ones that do, whatever probability there was that the plan was not going to be there in 20 years before, it is much higher after. So, and that's, you know, trying to be a relational answer there, because it's going to be a pretty wide spectrum. But and especially the size of this contribution holiday. You know, if you're currently 100% funded, so you're receiving 6% of pay from the employer and 6% from the member, and they take a contribution holiday for a year, well, you know, maybe that doesn't change much. But if you're currently 60% funded and you're receiving 30% from your employer, and they stop that, you get 0 for a year, that is probably the beginning of the end of that plan. I mean, it's going to be very difficult to come up with situations that are sustainable in any sort of way that people would define as sustainable. So, you know, so it's really situational, and so what I would say is fight for every dollar you can. I'm not a huge fan of the reamortization. One, it in most cases isn't going to get you that much, but also now you're taking all those previous layers and extending them even further in the future. Is try to come up with some other way of doing it, if at all possible, to keep those previous bases on the same pattern they were. But is that, you know, if I was ordering all the different options, I mean, then that's one of the least harmful ones. But in general, at the end of the day, all those things are just parameters. How many dollars you receive is what matters. So, how many dollars you get during this downturn over the year, however you design it, however you play with where it comes from or amortization periods or whatever. If it means that you get 10% less money, whether they change the amortization period or just decide you to give 90%, at the end of the day, it's going to have the same impact. And so we need to try to keep those contributions flowing in and come up with some other source if not, hey, put a bond out, do something to get money in this plan, because the harmful effects, as we've shown, if you get a spike in your payouts right at the bottom of the market, it's a multiple cost of that over time. The S&P 500, I think, is up 400% since the bottom of the Great Recession. Well, it was. and so any dollar that was paid out, it's 4 times that much by the end of the decade that you're missing. So this is all part of cash flow management.
So Senator McConnell, Senate Majority Leader in the United States Senate, is suggesting that states can just file bankruptcy. What can happen to DB plans in that case?
I mean, to me, that's a legal question. And it's probably going to be different in different states and different, jurisdictions. But I think if you're, there is counterparty risk in pension plans. As we said, the contributions are the lifeblood. If the entity is not there to give the contributions, then the benefits are at risk. There's no other, source. So just depends on what kind of state it is and what laws there are around that. But you're definitely at risk. I would say if your plan sponsor is going through bankruptcy, your benefits are at risk much more than they would be if they're not. So.
Right. I will just add my 2 cents, which is that states are sovereign entities without an act of Congress. States cannot declare bankruptcy. And if actually Congress ever acted to enable that, more so than public pensions, the municipal bondholders and that bond market would be the most affected. And I think there would be plenty of outrage about that. So, my 2 cents, I think the probability of that ever happening, i.e. states being able to declare bankruptcy, is 0 to nil.
Yeah, I agree with the state level, but I mean, there are clearly lots of pensions sponsored by municipalities, and those do have that risk in some cases.
That's true. That's true. We got a minute, just a real quick response from you all. If a plan is going through an actual experience study now, do you have any recommendations?
Yeah, that's a good question. With going through that with a number of our clients right now, it can be really challenging, especially when you're trying to look forward at capital market assumptions or forward-looking economic expectations. But a lot of times these studies need to be completed, whether it's statutory requirements or getting their assumptions in line for future valuations. So our suggestion is trust your experts, your actuaries, but also your investment consultants, your staff, all your legal counsel, everybody. Trust your experts to try to make the best decision. But the most important message around the experience studies is that, as we have been talking about, the cost of your plan is the actual behavior of your members, the actual life expectancy, the actual investment earnings. It's not the assumptions. The assumptions are really just to give us a starting point today to help us make the best decisions for tomorrow. So do the best you can, trust your experts, and just be prepared.
Joe Newton, Ryan Falls, thank you so much for this great presentation today. Thank you to our audience for staying with us, and please join us for our next webinar on Tuesday, May 12th, entitled The Impact of the COVID-19 Crisis on Global Real Estate. Joe, Ryan, thanks again.
Have a good weekend.
Thanks,
Thank
Hank.
you.